Welcome to our Monetary Roundtable. Today we're going to discuss the evolution and politics of money. We have with us today Don Roper, Professor of Economics at the University of Colorado at Boulder, and Professor Lance Gerton of Economics at the University of Utah. And I have this question I want to start with. When I look at this dollar bill, I remember my grandmother was telling me that I could take this dollar and get gold. And I noticed today that I can't do that. There's nothing backing this dollar except my faith that other people will take it. So the question I have for you is, does it matter? In other words, what are the critical differences to the economy when money has an explicit convertibility constraint such as gold versus when money does not? Can we start with you, Lance?
Okay. There's really two kinds of money, commodity-based money or paper money. With no commodity convertibility. And the difference is in the sort of mechanism that controls the supply of money. If the money is convertible into gold, then the central bank, the Fed, is limited in how much new money they can print.
So if I have X amount of gold, that limits the amount of money I actually have in the economy.
Right. Without commodity convertibility, then the central bank uses other mechanisms to control the supply, and those have been less effective in the last 60 years since we've gone off gold.
And what's the importance of the supply of money? I mean, why does it matter if we have more money or less money?
An increase in the supply of money eventually leads to an increase in prices. Shorter term, what it leads to is reduction in interest rates and changes in unemployment levels. So many economists think, monetary economists think, that the business cycle is really the product of monetary change, Federal Reserve behavior and decision making.
Well, how would that be different as opposed to when we had a gold standard? Didn't we also have business cycles during that period?
Sure we did. I mean, when you had gold mining discoveries, obviously we had an increase in the money supply. And when we had a shortage of gold, we clearly had some deflation. So the quantity of gold tended to run the economy to a considerable extent.
Okay, so you're saying business cycles had some origin in the quantity of gold, and if the quantity of gold varied, that would vary the supply of money and then result in a business cycle, as opposed to when you don't have convertibility, it's the actions of the Fed that vary the supply of money that may underlie the business cycle. But both have the same cause, the variability in the supply of money, or?
Well, one's kind of accident, new discoveries of gold, like in the 1890s. The other is conscious decisions. Although it's not real clear that conscious decision making has done a whole lot better than the accidents of gold discovery.
But I'd like to follow up that piece of paper about just a major question is, why does anybody give up their valuable labor or anything else of real value to hold something that's inherently worthless? And the reason is, at one level, is just that you think it has value, and so you behave as if it does, and those are self-realized expectations. And if we suddenly let go of those expectations, it would fall apart. The whole thing rests on that. Then you ask the question, where did those expectations come from that we ever got into this idea that that was always going to have value? And that's where the gold standard came from, because you couldn't get this otherwise worthless paper to circulate without something backing it. I mean, gold was just one of many commodities over time. And so we weaned ourselves off of commodity backing, and that's given it, and so we continue to behave as if we behaved back when it was backed by commodity, and that expectation is self-fulfilling, and that's what gives it value. And that's really kind of, so people ask that question, and I wanted to just look at that.
Well, why did we get off the gold standard to begin with? I mean, why the change, and when did we change from having this dollar backed by gold to?
I think that when we got off gold was in a real sense, was in the 1930s. That before the 1930s, prices, when they rose during wars, tended to come back. to where they had been before because we either stayed on gold or went back on gold at the pre-war parity. And the last one of those post-war deflations was the 1920s and the 1930s, the Great Depression. So I
A
think
deflation is what?
a drop in the price level,
Okay.
a general drop in the price level of a sustained amount. For example, during the Great Depression, consumer prices dropped nearly 25 to 30%, which is a very substantial drop. I think that was caused, or one of the important causes was the gold standard, that prices had been driven up during World War I. They were too high for the gold standard, and we stayed on the gold standard, and it pulled prices down and resulted in the Great Depression.
What do you mean by too high for the gold standard? So I have this fixed amount of gold. Suppose this is the gold we have. That's anchoring our currency. So explain to me what you mean by prices too high for that.
Say that, to make it simple, say that people can go out in the desert in western Utah and they spend a day searching or mining for gold, and they can get an ounce of gold. Okay, so an ounce of gold is convertible into 1 day's labor, unskilled labor, mining. Say that before World War I in 1914, say that gold values, price level was such that 1 day's labor would buy 1 ounce of gold, and 1 ounce of gold was equivalent to about $20, so $20. It was that. Those aren't the right numbers, but that's just for illustrative purposes. Now, during the war, the price level doubled. World War I, price level doubled. So that the value of a day's labor in terms of the commodities that could be purchased was cut in half. Okay.
So I had to work twice as harder to get the same amount of goods.
If you went out and used a day to mine gold, got your ounce of gold, and then went and bought goods, you'd only get half as many goods. So gold is undervalued. People would quit mining, the supply of gold would drop, and the processes after World War I is fairly complicated and not exactly this straightforward, okay? But at least in my view, an important part of the cause of the deflation was just that gold had been reduced in value with the inflation during the war, and there was some pressure to drive the value of gold in terms of other commodities back to where it had been before and in terms of labor.
If we broaden it, sort of like from why did we get off the gold standard, and the big event was surely the Great Depression, to why did we move from commodity money to commodity-backed money to completely fiat money over centuries? I think the answer is profits, because you can take gold and use it for other things, and you can use something cheaper than gold, paper and ticks on a hard disk. But certainly the gold standard didn't serve us well in the Great Depression. So having that control is something that we wrestled back by. We got that control back by abandoning it completely. And the de jure as well as de facto abandonment of the gold standard was probably August 15th, 1971, when Nixon shut the gold window and said no one could redeem any dollars with their gold, could get our gold with any of their dollars.
What Don's talking about in terms of the profit is when the Fed creates money today, that's a very profitable business. And if they had to create money by buying gold, that reduces their profits from doing that. So that a fraction of our government deficit is covered by the Fed printing money. That's the profit from it. From removing
that they couldn't have done if they didn't have the gold.
If they had gold, then they would create money by buying gold, so they wouldn't have the profit, wouldn't cover the deficit.
We ought to make clear, a lot of people get into conspiracy stories about the Federal Reserve because of the profits. I mean, it's an immensely
The
profitable.
Federal Reserve is the central bank of the United States.
Yeah.
Okay, go
So
ahead.
central banks are immensely profitable, and so people get into conspiracy theories about it. And just everybody should know that that money, those profits get kicked back to the governments. So they go into the general fund. It's the guys at the Fed aren't pocketing this stuff.
Okay. Now I wanted to get to this issue that since we're off the gold standard and we don't have any real anchor for our currency, we basically rely on the Fed. We put our public trust in the Fed to maintain the value of our currency so that we don't get hyperinflations where our money becomes worthless. Can we trust the Fed to maintain the value of our currency? What's their record on that? And then the second part of my question I would like to ask you is, you have an option called competitive currencies as an alternative way to maintain the value of the currencies. So first, can the Fed maintain the value of our currency? Can they do a good job?
You want me to start? There's really not one single objective for the Fed. The Fed looks at unemployment and inflation, exchange rates, and so on. And some people say people that are on a fixed income, they care mostly about inflation. They don't want their income eroded. Young people, new entrants into the labor force, they surely care more about whether they're going to have a job or not, and less about the value of money. And the Fed is, to some extent, pulled between these two. The Fed's record on inflation is not good compared to before the Great Depression. We've had a gradual erosion of the value of money. Since World War II, probably the value of our money has dropped to 25% or maybe 20% of what it was right after World War II. But in terms of, well, that's a hyperinflation. That's not a hyperinflation. An average inflation rate of 3 or 4% is probably what we've had in the last 50 years. But the Fed is also concerned about, or should be concerned, about unemployment. And when unemployment goes up, the Fed has a competing objective to just trying to maintain the value of the dollar. And to some extent, this represents a conflict between older people who are maybe richer people who are on fixed incomes or who are more concerned about the value of money, and working people or younger people, new entrants into the labor force, who are probably more concerned about the Fed fighting unemployment. To some extent, that's a split between Republicans and Democrats, perhaps, views.
We can tell some stories that I think are important about that put central bank policy in a historical context. Like the Fed blew it in the 70s, coming out of the Vietnam War. The difference between real and nominal interest rates wasn't that well known, and the Fed kept looking at nominal interest rates, and they kept supplying more.
The difference
more
between
money.
nominal and real interest rate is the expected inflation, right?
Yeah, so you have to take the market rate and net off the inflation rate to get the real rate of return. And we hadn't learned to watch that very well. We all know that now. That's in all of our principles books. But the Fed blew it in the 70s, and they finally regained control of monetary policy in a big way when Volcker came into power, and we had the revolution in monetary policy of October 1979. And now I think the Fed is being too tight and continues to be too tight. And so...
By too tight, you mean what?
Their interest rates they've been holding interest rates too high, except in '92 when they dropped it during the election. They've been holding interest rates very high. And one of the things going on is that monetarism has swept the field. We used to be under sort of a Keynesian view of the world, and with the Vietnam inflation and with the continuing inflation during peacetime after Vietnam, because I believe we finished going off the gold standard, we didn't give enough weight to real rates. The Fed lost it, and now they keep trying to regain credibility. Monetarism has taken over our thought, and so everybody is looking at, is the Fed going to monetize the debt someday? and take care of the budget debt. You know, we can take care of the federal debt very easily. All you have to do is monetize it, print money, and replace it with paper currency, and that's, you know, hyperinflation.
Use the money to buy the debt back.
Yeah. So,
I mean, is that a real concern, though, that the Fed would monetize the debt?
Well, the way
Yeah.
I ask my students,
Monetizing the debt is when the Fed actually buys Treasury bonds,
Right.
buys the debt of the
would you buy
government.
a 30-year bond today? Well, what's your big fear? Well, what is the average inflation rate going to be over the next 30 years? If 30 years ago in 1965 you had bought a 30-year government bond, when it pays off today, it won't buy near as much as what you put into it in 1965. So what is the inflation rate going to be on the average over the next 30 years? Well, nobody knows, but if they're afraid that the inflation rate's going to be high, then people are going to be reluctant to hold those bonds, and the rate on them will be very high. And the pressure on the Fed is just go support the bond market by buying those bonds with new money, which will cause the inflation.
the pressure on the Fed from the federal government, from the White House.
Right.
Yeah, there's always, whether it's Democrats or Republicans, the White House, the Treasury tends to lean on the Fed to loosen up a bit. But my view, I think Lance and I probably disagree a little bit on this, is that the Fed waited too long, too late to tighten up after the Vietnam War, and they've waited now too long to loosen up as they keep trying to regain their credibility in their ability to fight inflation. So,
But I mean, we've had very low inflation over the later 80s and 1990s.
yeah, but there's this worry that, as Lance was talking about, that the Fed will monetize some of this debt. In order to take care of the debt, you just buy it up. And I think there's so many people watching for that they can't possibly do it.
So if they
I
do
think they're erring
monetize,
on the tight side.
if they do monetize the debt, what does that mean for the economy as a whole?
Inflation.
And why do you get inflation from that?
That what they do is print new money, essentially, and buy the debt back. So the supply of money goes up, and more money chasing the same amount of goods, eventually the price level will rise. One thing Don is alluding to, I mean, one view of what the Fed has done recently is they've done a very good job. We got low inflation rate and low measured unemployment rate. But I think what Don's alluding to is despite the measured low unemployment rate, people are insecure. The sort of things that people say and you read in the newspaper are not the sort of things that normally we read during good economic times, when we got low inflation rate and low unemployment rates. And I think Don thinks that the measured unemployment rate is masking real problems in the labor market.
What kind of problems are? We're getting a little off monetary theory, but let's look at this for a bit, and then we'll come back on course. What kind of problems are being masked?
Well, I mean, we're getting outside my specialty, but we worry about growth without jobs. We worry about downsizing. People are worried about their jobs, right? The government the central bank has looked. We didn't have another Great Depression in the 80s. GD2 did not happen. Lance and I think that debt was a key variable of the first Great Depression. The second Great Depression didn't happen because we weren't going to let the financial system go under in the 80s with all that bad debt. I mean, Japan's looking at the same thing right now. But I think that we may let a lot of individuals go under as their debt bubbles burst, and I worry about that a lot.
This may be beyond our area of expertise, but it is central to monetary policy. And when people are at the board are making decisions about monetary policy, they look at measured unemployment, but they're also supposed to have an antenna that says, is that really what's going on, or are there problems being masked, and so on. So the sort of things that we are talking about are the sort of things that the Fed is concerned with and should be concerned with.
Well, getting to this inflation unemployment, I mean, we read all the time about the Fed targeting the level of inflation or unemployment. How do they decide Is there a trade-off, and how do they decide how much unemployment they should tolerate? I mean, in the 1990s, 6% unemployment is considered full employment. In the 1960s, it was 3%. And what's going on here?
Let me address it in just a little different way. There are constantly people pulling on the Fed for looser policy and people pulling on the Fed for tighter policy. There's a constant, they're just pulled all the time.
And looser policy is an expansion in GDP, and tighter policy slows down the growth.
Yeah, but I'm thinking primarily just about interest rates.
Okay.
And the Fed is always, any central bank is always liable to err on one side or the other. They wound up looking back and they were too tight, or they wound up looking back and they were too loose, right? And I think that that's explained by the political, by the politics of the Federal Reserve governors and the bank presidents, the Federal Reserve of any central banking system, and as to who they're going to listen to the most, namely the tight money folks or the loose money folks.
Okay, who are the tight money folks, and who are you referring to?
The financial interests typically want stable prices.
Such as banks and investment houses, pension plans, this kind of...
Wealthy people tend to...
Such as us.
They're typically more concerned about the value of money and less concerned about a job because their jobs are secure or their wealth is secure.
So these are people holding stocks and bonds.
Yes, yeah. And they tend to vote Republican, probably. The other side are the labor force, the young people, new people into the labor force, who also typically are more Democrat. So the board is pulled between these different camps, and typically, as one would imagine, not being a conspiracy theorist, but still the financial interests have a heavy voice at the Fed, and perhaps the unemployed or the potentially unemployed have a weaker voice at the Fed.
But this would tend to say that in these two groups at the Fed, I wanted to ask you, do workers end up paying to preserve the wealth of the groups who are concerned with keeping inflation low? I mean, workers end up with less job opportunities or higher unemployment rates in order to keep inflation down, which benefits those groups who hold financial assets. Is there any benefit to workers from this policy? Is there like a trickle-down kind of?
There's a delicate balance. So the financial interests of the country don't want a depression. They don't want high unemployment because that reduces financial values also. But as between a little bit higher unemployment or a little bit lower unemployment has to do with the balance of power in labor negotiations and unions and so on. For example, today I think that some of what we're seeing is the result of the high unemployment during the Reagan era, where unions were hurt, and we're continuing to see the effect of that in the sense that workers who might be more aggressive in pursuing higher wages, having strikes and so on, can remember unemployment of above 10%, and that tends to shift the balance of the negotiating power toward the business side, the wealthier side. Say we continue on at less than 6% unemployment for a decade on the average, say at less than 6%. Well, strikes are going to go up. Workers will be more confident, more aggressive, and perhaps their share of income will go up. So we're talking underneath the Fed is they don't determine the share of income between labor and capital or property, but they influence it, and that's going on underneath Fed policy, I believe.
See, I think that tight monetary policy does hurt a lot of working class people in debt, but I think it has to be juxtaposed in a historical sense between the loose policy of the 70s and then the tightening up of the early 80s, that I think that we're still in that story. And during the unnecessarily loose monetary policy of the 70s, it paid to go into debt. That was the age of the debtor. So if you could throw out we learned to throw out all of our rules of prudent behavior in terms of going into debt. We learned to leverage up because it kept making us huge returns.
Because of inflation.
Yeah, because the inflation kept paying off the debt. The inflation kept giving you real estate values that were much higher. And so all the rules of prudent borrowing were thrown out the window. And then in the early 80s, you started getting deregulation as well. And so we got into this huge debt mentality. And now we're continuing to be whipsawed. And I'm concerned about consumer debt, for instance, that is in part the result of something that started way back in the 70s that changed our attitude towards debt. And after the 90s, I think debt's going to be, it already is to some extent, a four-letter word. But there's still a lot of people deeply in it, and they're hurting.
Okay, and with that, I'd like to thank you both for joining us today, and thank you for watching our roundtable.